Harvard Business School Executive Education presents the Investment Management Workshop, an immersive program for experienced investment professionals navigating today's complex markets. Designed for executives and investment management organizations, this three-day program sharpens investment judgment through rigorous discussion, real-world cases, and direct engagement with HBS faculty at the forefront of finance. Participants step away from their day-to-day noise to refine their thinking, challenge assumptions, and gain frameworks they can immediately apply to their investment process. Learn more about the Investment Management Workshop at hbs.me/investment. That's hbs.me/investment. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast David Schassler. David is the head of multi-asset solutions at VanEck. He has over 20 years of investment experience, joining the firm in 2012, and prior to that was at UBS. VanEck, as a firm, has over $180 billion of assets under management, offering over 240 investment products offered globally. David, welcome to the podcast today.
Thank you so much for having me.
David, let's start at a high level. Obviously, very dynamic market as we're meeting today. What's your current assessment of the macro and overall backdrop for investing?
Yeah, so we are macro thematic investors. What does that mean? We are looking for the big themes that are going to drive markets compound wealth. As macro investors, I've got to tell you, this is one of the most target-rich environments you can ever have. I mean, you've got the collision of extreme disruption. We're talking about AI. We think AI is going to drive productivity. That productivity is going to drive economic growth. We think it's going to change things. It's going to be more profound than people expect. It's going to happen faster than people expect. Theme one, right? The second, though, is directly related to that. How are we going to build it? Old world assets building the new world. New world doesn't happen without old world assets. Real assets have been on one heck of a bull market now for 5 years. We think that that's not the end. We think there's a lot more room to go. We talk about that, right? And then the third part is, well, how are we going to pay for it? We've been structurally overspending in this country for decades. We are in the period of financial accountability. Debt matters, deficits matter, spending matters. It's not an accident that gold's a top-performing asset. Not an accident. So if you combine all this together, really what I'm saying is that we're in a period of disruption. We're in a period of innovation. We are setting ourselves up for a lot of growth, but that happens off the back of a massive CapEx cycle. It's going to last a long time. It's going to cost a lot of money. And we're going to pay for it with debasement. It's going to send gold prices higher. Not to mention geopolitical risks. We stand here now as, unfortunately, the war with Iran is continuing to escalate, sending commodity prices up. Gold down a bit today, but that's typically what gold does during these big downdrafts. Bottom line is that this is a period of time that rewards and favors diversification. It's a period of time that demands diversification.
What about interest rates and the Fed leadership? That was, up until recently, a very hot topic. What's your expectation there, and how does that impact asset allocation strategies?
Yeah, so generally speaking, the world is looking at countries that have too much debt, and it's demanding more of a premium. Now you get short-term shocks that will throw things off kilter. But regards to the Fed's path, the recent Fed nominee, the struggles here and the general issue is that, by and large, what people want to do and what they can do are two very, very different things. And the path of interest rates will be governed by growth and debt. And once you have a handle on where you think growth is going, where you think debt's going to go, I think then everything else falls in order. So I'm not necessarily hawkish on what's going to happen at the next Fed meeting. I think that's a lot of white noise. I think, generally speaking, we are on a path towards persistently upward pressure on interest rates given the debt situation that we have.
At some point, do you think there's a day of reckoning to come?
The United States in particular, but this isn't just a U.S. issue. The United States has been overspending for a long period of time. CBO estimates of total debt for the government, by 2035 or somewhere in the world of $59 trillion. We're probably a lot higher than that. Why am I saying that? That assumption doesn't factor in recessions, crisis, impending, huge tech spending that's not already approved by Congress. Point being is that we're going to end up in a situation where we spend a lot more. Debt's going to rise. Interest rates are going to push that debt amount up. All roads, in our opinion, lead to more debt. That's a huge part of the reason why gold is rallying. A huge part, not the only piece, but that's a huge part. Gold's an opt-out asset. That's when investors look around and they say, no, thank you. That's them omitting themselves from the system and preserving their wealth in an asset with embedded scarcity out of the fiat system. That's why gold, that's a primary source of the gold performance. The other part of that is that the world universally has woken up and said to the idea that, well, we need a truly neutral reserve asset, an asset that just can't be confiscated by another government by the push of a button. And that's what gold is. And when you get into these regimes, and you see time and time again over periods of extended history, gold is the asset you end to. Gold is the asset that has outsurvived every monetary experiment in history, and that's where we're going to again.
Any other particular risks that you think investors or the consensus is underestimating or should get greater attention?
The hype is real on AI. It's not overhyped. The hype is real. When I say that, what I'm saying is that AI is going to drive mass productivity. That productivity is going to drive economic growth. It's going to change things. It's going to happen faster than people expect. It's going to be more profound than people expect. And I don't think people get it, right? I think generally speaking, people are thinking about the internet. Internet changed everything. Internet made a lot of big promises, completely over-delivered. But here's the difference. Well, there's two differences. The first is rate of adoption. The internet unfolded over 20 plus years. So when things change slowly and incrementally, it doesn't feel as dramatic. But if you had a time portal and you were to go back 25 years ago and say to yourself, well, how different is the world now? It'd be hard to fathom. So if that change was compressed to a 5-7 year window, it would be startling. It would drive mass disruption. That's the first part. The second part of it, and nobody really knows the answer to this, so I'll hedge what I'm about to say with that. But AI is a general purpose technology, and people will compare it to the internet. They will compare it to the computer. But the big difference is this. AI is not designed necessarily to enhance the productivity of the user, which is the human being enhance the productivity of the human being, but in many ways replace. And then once you combine it with automation, you're replacing both mind and body. And you're seeing major employers like Amazon basically creating a blueprint on how they can drive mass automation through the usage of this technology from front office to back. So I'm just saying, antenna way up, because things are about to change dramatically, and it's going to catch a lot of people off guard.
And if AI productivity, if that narrative accelerates faster than expected, is there a particular asset class that will benefit more than others, or is it sort of equal?
So the biggest bottleneck on making AI a reality, in our opinion right now, is energy and infrastructure. That's a clear bottleneck that must be cleared. So we are playing technology, right? We are long technology, but we're also long real assets. How are we going to build it? The conversation starts with data centers. So in 2022, we kicked off one heck of a CapEx cycle driven towards building out data centers. That's where the conversation starts. How are we going to power it? And we think that you're in the early stages of a massive CapEx cycle.
Shifting to surprises to the upside, any areas where you think there's positive surprises to come that you're looking at next 6 to 12 months?
I think that people are going to be surprised by the rate of adoption of AI. So we think of AI in 3 phases. First was the build. The scarcities benefit the most. That was in compute. You saw nuclear energy run. Phase 2 is adopt. Companies rewarded from adopting this technology to drive productivity, drive economic growth. And then phase 3 is automate. Now, we are stuck somewhere between phase 1 and phase 2. Phase 1 is going to be extended build out, but phase 2 you're going to start to see. And I think that will catch some people off guard. And I also think that you're also going to see continued strength in the CapEx build out, which is going to drive real assets.
And given that as a backdrop, what are you hearing from clients in the current environment? And obviously, it could have been a shift in the last week with what's going on in Iran and things like that. But what's the sentiment, you would say?
People are opening their mind to diversification in a way that I haven't seen in a while. So the understanding that you need to build an asset allocation that's going to be resilient, independent of the economic regime, right? And that's not the economic regime you hope for or want. It's all reasonable outcomes. And there's the idea that we can remain in the regime that we're currently in. We're not saying that, we're not calling for a regime that's not hitting. We're saying that is a very high scenario where the current regime that we're in that favors diversification, it favors asset allocation beyond just stocks and bonds continues. That's not a zero probability event, right? We think there's a very high likelihood of that. People are looking at their statements and seeing U.S. equities not making much this year, flat, and a lot of real asset segments up 20%. Right? That's catching people off guard. It was one thing when all assets were rallying and real assets were part of the mix. It's a very, very different thing when other assets are starting to stall out and real assets are actually accelerating. And I think that that's starting to get people's attention towards it's probably a good time to diversify beyond just stocks and bonds.
And let's dig into you just touched on, let's dig into the various elements of a diversified portfolio. You mentioned equities. Where do you see equities overall fitting into a multi-asset portfolio today?
Equities are the backbone of growth. We run multi-asset portfolios. We run dedicated real asset portfolios. So, our group in particular, so I work in a group called Multi-Asset Solutions. We're kind of the Swiss Army knife as it relates to asset allocation. We have the flexibility to invest anywhere. So we've got heavy equity allocation. So we are biased towards the U.S. We are biased towards technology. We are biased towards a broadening of markets beyond just the Mag 7 stocks. So we're structurally underweight those names, broadly diversified, overweight technology, diversified across geographies, across industries, across market capitalizations. So we're positioning for a continuation of technology growth, but a broadening. And you'd expect a broadening as we move from the build to adopt, because the adopt is about leveling the playing field and driving productivity across industries. And that's what we're setting up for.
And you touched on, the AI, the mega cap tech stocks. Those obviously have been fairly dominant. Just wondering, things like halo stocks have sort of surfaced, and also international indexes seem to be doing pretty well. What's your assessment of your take on those kind of trends?
We believe that markets are efficient, but not perfectly efficient. So what you just did, you rattled off a bunch of things that have been working. That's the market validating a thesis. So I think generally speaking, you're seeing structural changes and trends. The one big one that jumps out is U.S. versus international. You've seen strong performance from emerging markets. We think that continues. We're still overweight the growth segments within the United States, but we play it a little bit differently. So we are long growth, but we are hedging ourselves against the dollar and other fiat currencies through gold. We also will own Bitcoin as well. So we think about it as owning assets with embedded scarcity, right, to hedge against fiat currency debasement, which extends beyond the dollar. So what we are is, if you think about our asset allocation, long growth, and we think growth is going to be centered in technology. This is a technology super cycle. So we're leaning into that. We're playing a broadening, and we're hedging the debasement, because how are we going to pay for it? And we think we're going to pay for it with continued debasement based off of our forward-looking views of debt and spending.
Shifting into fixed income, how do you think about some of the elements there? Treasuries, high yield, emerging market debt. Is there any sort of priority order to how you would assess those?
Yeah, so we think of, we run balanced portfolios, and maybe I should start with this. If you think about our asset allocation, when I said before we want to perform well independent of the economic regime, what I'm saying is that we want something in our arsenal to perform, whether we're in the high growth regime, low growth, high inflation, low inflation. So we own lots of stocks, but we also own bonds, and bonds are our ballast within our portfolio, plays a role. And that only works if you've got the right style of fixed income. More specific, we've got lots of treasuries. We have duration in the portfolio. Duration is a key risk within the portfolio that drives the diversification elements across asset allocation. And then we've got solutions within fixed income that provide us differentiated yield sources to drive diversification. And our purpose of our fixed income portfolio is to effectively be risk neutral to the aggregate bond index. So be in the same vicinity, maybe not perfectly risk neutral, but same vicinity from a risk perspective, but to yield higher. So if we can do that, we'll have the ballast from the duration benefits within the portfolio if we get into a risk off, but carry higher through a higher yield. And we'll invest in things like CLOs. We'll invest selectively in high yield. We'll invest in fallen angel high yield. So we'll invest in international or emerging market fixed income. So there's ways for us to broaden out scope, increase diversification, increase yield, but effectively remain risk neutral versus the aggregate bond index.
And private credit's been in the news a lot lately. How do you think that'll play out? What are your expectations there for that market?
We've seen cycles like this play out time and time again. Interesting idea, fits a need, gets overdone. Lending standards loosen, problems emerge. Now, especially that compounds when you introduce extreme disruption on existing business models, and they may not prove to be as resilient as once thought. So I get it. I get the risk there. So what we'll say about private fixed income, but this extends beyond that conversation, is that everything fits. It's a magnitude conversation. It's a dosage conversation. So having a reasonable allocation to a private credit manager that you're comfortable with makes sense as long as the dosage is right. So what we're saying is that size it properly and life will be good. Oversize it and you're going to have a problem, especially in the regime that we're going into. And the wind's not at the back of private credit right now for the reasons I just laid out.
And do you foresee, is it possible it could be private credit could become a source of sort of systemic risk?
I don't foresee a 2008 style of event, but as I said before, if you lend money to companies and the business model is structurally disadvantaged because we're entering a new regime and their ability to pay suffers from that, and you've got too much of it, you could see risks rising in the system. So where it goes from here, we'll see. The best protection against that as an investor is don't overallocate.
And now a word from our sponsor. If you work in investment management, this might be worth your attention or something to pass along to someone in your network. Harvard Business School is not just about the MBA program. Did you know it also has more than 60 short programs for working executives? One you may be interested in is the Investment Management Workshop. It's a highly interactive, 3-day in-person program held on their Boston campus, and it's designed for working investment professionals. During this program, you get to step away from the day-to-day market noise and spend time digging into how investors actually think about risk, uncertainty, and capital allocation, especially when the answers aren't obvious. The focus is on judgment, perspective, and decision-making. You'll learn alongside a global group of peers and engage directly with HBS faculty who are at the forefront of finance. If you want to learn more about the Investment Management Workshop, head to hbs.me/investment. That's hbs.me/investment. And what about, you touched on real assets at the beginning of the podcast, you mentioned gold a lot. Any other commodities that you think are worthwhile to include in a portfolio?
The first thing I'll say about real assets is this. Investors should have at least 10% to diversified real assets. I would fund my gold from my fixed income. I would fund my growth-oriented real assets, more cyclical real assets, commodities, natural resource equities, infrastructure development. I would fund that from equities. If you do what I just said, you should effectively be in the same risk category, right? So your volatility shouldn't change meaningfully, but your opportunity set should widen significantly, meaning you should now have a more resilient asset allocation to perform well, independent of the economic regime, particularly the regime that we're in right now. So my first driving point is that if you look at your asset allocation and you don't have at least 10%, I'd rethink that, because this is the regime that structurally favors diversification. And you could, so as we're sitting here today, energy prices are soaring simply because of what's happening in Iran. And that gives you another leg on the importance of diversification. Within real assets, I think that you're probably looking towards a 5% allocation to gold and the rest of it allocated to diversified real assets that are going to benefit from the infrastructure build out, from the energy build out, from old world assets building the new world, from traditional energy.
And central banks have been part of the equation for gold, right? Do you expect that to continue? And is that basically a tailwind for gold, do you think?
Foreign central banks purchasing gold is a natural reaction to the situation on the ground. When Joe Biden weaponized the dollar against Russia in defense of Ukraine, he made a very big global statement. And that statement was that the U.S. dollars, the U.S. treasuries are not a neutral reserve asset because it can be weaponized against you. That's understanding that, and if you're in conflict with the United States is one thing, but I think countries around the world are looking at this and saying, we need a truly neutral reserve asset. We need an asset with actual independence, one that just can't be confiscated if we fall on the ill side of another nation. So it's a natural knee-jerk reaction to seek out an independent neutral reserve asset. The current administration has been the source of significant volatility. They're much more amplifying what was originally done with the weaponization of the U.S. dollar against Russia. So, point being is that the Russia confiscating the reserves from Russia was the first major step. Since then, we've been kind of compounding that. The natural reaction for countries globally is to diversify away from the dollar, and that's what you're saying. If more countries own gold as opposed to U.S. Treasuries as neutral reserve assets, I ask the question, what's actually the neutral reserve asset? I would argue that's gold.
Digital assets like Bitcoin, where do they fit into sort of a more multi-asset portfolio? We've actually had a significant pullback in the price. The investment backdrop right now seems a little bit higher risk. What's your take there?
So I'll give you, let's start with the structural reasons why you should own it, and then we can talk about where we think it's going. So, and we can do the same thing with real assets as well. So where does Bitcoin fit? So we're asset allocators. If you give us a differentiated return stream, Bitcoin's now a teenager. It's outperformed most assets in its existence by a wide margin. It's a differentiated asset. Sometimes it may look like this asset, sometimes it may look like that asset, but it's a purely differentiated asset, which means that the expectation is that any correlations to any other asset classes, because it's truly differentiated, will break down over time. So now, as an asset allocator, if you're spreading risk and you can reach into your toolbox, grab an asset that's highly differentiated, that has a strong, compelling long-term performance profile, well, that's really attractive. And then you start to think about the narrative. Well, where's the world going? The world that we're moving into is a digital world, and we're moving there very, very rapidly. It's a world that favors transparency. It's a world that favors efficiency. Bitcoin fits very, very cleanly into that. And it also has embedded scarcity, so it has store of value metrics as well. So if you put all those things on top of each other, I think it's really compelling. And now on top of that, as we sit here, Bitcoin's below 70,000. Somewhere between 60,000 and 70,000. I think it's pretty low-hanging fruit. And when you look at the asset mix and a lot of things are stretched, thinking out 24, 36 months now, we think buyers at these levels will be rewarded. But at the end of the day, the simple question that people have to ask themselves, if they look at their portfolio and they see a 0% allocation to Bitcoin, they've got to realize that this asset's been institutionalized. It's been adopted. It's been accepted. We don't think it goes away. And if you don't know if it's going to go away 100%, right? And if the world's moving in that direction, the right answer is not 0%. If you own 1 to 2%, doesn't change your risk profile. But just like with real assets, it increases your opportunity set. It helps you create a more efficient, more resilient asset allocation. And that's what we're all about.
And other alternatives like hedge funds, their place in a broad portfolio?
Hedge funds, too broad of a term. So generally speaking, we're talking about alternatives. We're talking about strategies that we're talking about traditional assets used with an alternative strategy to create an alternative return stream. Some of them have more merit than others. I think you've got to be very selective there. You've got to be very fee conscious there. By and large, traditional betas, strong risk management, have proven to be the tortoise that wins that race. So for me, I think, and for most investors, I think they can omit it. But if you've got a skilled manager that compounds wealth, they exist. We're not opposed to that. They're less plentiful. Let's leave it at that.
And when you look at those, it's a combination of prior returns plus the strategy that sort of says, I have conviction going with the hedge fund, or is there other variables in there that you like to look at?
So I started my career in due diligence. And what I'm about to say, I believe very, very deeply. A strong investment performance profile is nothing more than a validation of a sound investment philosophy and a consistent, repeatable process, strong, rigorous risk management. So if you look at somebody and they've got a truly independently verified, strong performance profile across regimes for an extended period of time, 10, 20, 30 years, well, that's worth a look. That means they're doing something differentiated, especially if they're overcoming a very high fee hurdle, which you typically get with these hedge funds. So They exist. They're out there, but there's not a lot of them. So choose wisely.
And when you factor all these topics we've discussed, and you think about your model portfolio today, what does that look like? What is the asset allocation roughly, if you can give us, for your portfolio?
Yeah, so our world starts with the classic 60-40 as everybody else's does. We just run significantly more diversified. So we'll take the 60-40. We'll put 10% to diversified real assets, as exactly as we described. 4% for fixed income, funds it, 6% from equities. So now, right, we're off the 60-40 because we're going to add 10% to diversified real assets. We're going to push it further. We're going to add 2% to digital assets. Right now, we're excited about digital assets because it's sold off so much. So now digital assets, let's say maybe we go to 2.5% in this regime. So now I've taken a traditional asset allocation, the 60-40, made it significantly more diversified, more resilient. I would argue more optimal to perform independent of the economic regime. But here's the most important part. Statistically, the volatility profile is very, very close, which means more efficient portfolio because you've got a wider opportunity set with effectively the same risk profile. And then when you wake up and see days like today, right, when the battle in Iran is intensifying, you're seeing oil prices spike, and you're looking for what's working in your portfolio, you're seeing real assets really perform. So it just shows you need something in your asset allocation that performs independent of what can happen tomorrow. And if we've learned anything over the last 5 years, starting with COVID, you have no idea what's going to happen tomorrow. You have no idea. So when you put your head on your pillow at night, you've got to have something in your toolbox to perform independent of what happens. That's why our message, regardless of what you hear today, it's all about diversification. It's all about hedging yourself. It's all about spreading the peanut butter across the asset allocation to perform independent of what happens.
And that traditional 60-40 portfolio that's been in place for a very long time, what's your thinking on that?
That was fantastic in the period of monetary dominance. We came off of the Volcker regime with short-term interest rates close to 20%. We were in a period of low inflation. And what happened was we lowered interest rates constantly for decades. And it allows us to completely overlever. So we increased debt. At the same time, interest rates were falling. So the costs we spent on borrowing effectively stayed the same. That was awesome until it wasn't. And then we hit COVID. During COVID, interest rates hit the floor. And then inflation pushed us off that floor. And we've switched from a period of monetary dominance to a period of fiscal dominance. When that happened, under the surface was this extreme technology that has the ability to change the world through productivity, through economic growth, and drive mass disruption. But it's also super hungry as it relates to energy. It's super hungry as it relates to the infrastructure build-out. And if the hype is real and it drives productivity and that productivity drives economic growth, you're talking about a world that requires a lot more energy, right? If you have a higher living standard and you live longer, I just defined a person that consumes a lot more energy. People that live longer obviously consume more energy than people that live shorter over the duration of their life. So we're laying out a foundation for people that are going to be consuming more because life will be more plentiful, more abundant. In that scenario, we think all roads lead through real assets.
And that's been one debate, I think, in the market. Data centers, are we overbuilding or is it not going to be enough? Do you have a viewpoint on that? How do we gauge that the demand and supply is going to sort of match up at some point?
So we are in the midst of one of the biggest, if not the biggest, CapEx cycles in history. Now, either it's going to be the biggest waste of capital ever, or this technology is the real deal. And that's the camp that we fall out on. Now, infrastructure as it relates to data centers is where the conversation begins. It extends much more beyond that. How are we going to energize this? How are we going to move the energy? But there's also a catalyst behind the scenes that we haven't spoken about yet. And that's reshoring production. During COVID, it became abundantly clear that we don't make much in this country. You know, if you want your taxes done, we're awesome at that, right? We can print things, but you can't print energy. And our supply chains are extraordinarily vulnerable. And now you're seeing it right now, particularly on the war side. At this rate, we're burning through munitions really, really fast. Global spending towards infrastructure and defense is only going to accelerate because the state of warfare is changing. So if we're going to reshore production effectively means that we're going to build what already exists now. We're going to break apart, not entirely, but in many ways, the system of globalization. So the idea that we can trade and drive the lowest cost of goods and services by relying on our efficiencies to we have to build at home for national security, that changes the math. That's not a fast build out. That's going to happen over decades. That's going to cost a lot of money. It's going to be more expensive and longer than people expect. So this all comes back to the real asset narrative of where's the world going? And the direction the world's going to is a significant critical infrastructure build out to support all of our ambitions.
And you're always to some extent in the market with a sort of expect the unexpected. And now we've started that year on many fronts. I'm just sort of wondering, in that environment, what are the hardest or more challenging portfolio type decisions to make? And how is it just you manage through the risk through diversification or something else?
Yeah, so we have 3 layers, and this is the perfect segue right now to talk about this, because if you don't construct portfolios and manage risk well, nothing else matters. And that's, generally speaking, where a lot of people get it wrong. So let's be more specific. We have a 3-step investment process. We've been talking about macro and thematics and talking about where the opportunities are. That's a huge piece of it. So we always have what we call prudent thematic exposure, meaning leading into the structural themes that we believe are going to drive markets in the future. Got that. But then you're left with, well, how do I actually construct a portfolio and how do I manage risk? This is so essential. You have to build a portfolio. The first line of defense is through diversification. Got it. So have something in your toolbox for each economic regime. So once you go beyond that, though, once you diversify beyond stocks and bonds into real assets, into digital assets, create a truly resilient asset allocation mix. How do you actually build a portfolio that targets the right level of risk? So what we do is we have a volatility number, right? We're looking at, in an all-in asset allocation, we want to understand tracking error versus the 60-40. We want to understand relative volatility. How much volatility are we taking versus that? Then we could start to think about how much risk are we taking. But this is the second most important part of that. You have to understand your limitations as an investor. A great investor is not right 90% of the time, 80% of the time. Unfortunately, not even right 70% of the time. We're 60, right? But it is better than a coin flip. So what you have to do is you have to understand your limitations as an investor, and you have to compound your advantage. So you have to make lots of thoughtful allocations over and over and over again. And the aggregation of those views drives performance, not an individual position, because you have to stomp out any binary bets. They cannot exist, because if your batting average is 60%, which most likely it's not, that means there's a 40% chance you got it wrong. And if the bet's too big, that means a 40% chance you're going to miss your objectives. So what we do is we stomp out concentrations of risk. And like I said earlier, spread the peanut butter, because you need to target the right level of risk and make sure you've got diversified sources of risk that drive that, and then continues to the next part. There's no room for dogmatic investing, or there's no room for extreme hubris or egos. As an investor, if you're excited about something and the market's rewarding that position, that's the market slapping you on the back and saying, great job. But alternatively, if you're excited about something, you did a lot of work on it, and you think it's going to work, and the market continues to punish it over and over and over again, it's pushing the price down, it's very, very volatile. Well, that's the market telling you to do more homework. Do more homework. And as that short-term momentum turns to medium-term momentum, in our opinion, we don't add to it at that point, right? What we're doing is we're saying to ourselves, the market's clearly telling us something's not right here, and we're looking to de-risk. And as we segue from medium-term to long-term momentum, negative relative momentum, we want to be out of that position. It started as a good idea, but it didn't work out. The thesis was being invalidated by market pricing. So we're not going to ride something. We're not going to double down on things. That's most of the time. But I want to extend that a little bit. Market's rational most of the time, but not all the time. Extreme volatility creates opportunities. So what I just described was 95% of the time or 98% of the time. But then there's the other couple percent. And during those periods, opportunities are actually created. And if you're not overexposed, you have the ability to deploy capital to take advantage of inefficiencies in the market. So generally speaking, almost all the time, we're following momentum. But sometimes when we get on the extremes, we're actually going to use market volatility, market panic, and we're going to step into that and take advantage of dislocations. And that's the way that we manage risk from an aggregate level and take advantage of near-term efficiencies, and also take in market pricing to understand what we're getting right and what we're not getting right.
I mean, lastly, you've given us a great overview of your investment process and how you allocate. If you had to summarize just for the remainder of 2026, what's the playbook?
The world has changed. The world changed in 2020. It's a world that favors and rewards and demands diversification beyond just stocks and bonds. Run resilient asset allocations, run resilient portfolios, lead into these structural themes, but always fall back on a diversified asset allocation. So look at your portfolio. If you don't have real assets, double think that. If you don't have digital assets, that's an opportunity as well. But now is the time that rewards diversification.
David, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Harvard Business School Executive Education presents the Investment Management Workshop, an immersive program for experienced investment professionals navigating today's complex markets. Designed for executives and investment management organizations, this 3-day program sharpens investment judgment through rigorous discussion, real-world cases, and direct engagement with HBS faculty at the forefront of finance. Participants step away from their day-to-day noise to refine their thinking, challenge assumptions, and gain frameworks they can immediately apply to their investment process. Learn more about the Investment Management Workshop at hbs.me/investment. That's hbs.me/investment.